Hi, I'm Steve LaFrance with Blakely Financial. Happy New Year! So much happened in 2021, so let's quickly recap the highlights and look at how things are shaping up for 2022. The fourth quarter was a mixture of all the investment themes that defined 2021. Consumer demand remained strong, inflation pressures intensified, the labor market remained tight, a new COVID-19 variant started spreading, and the Federal Reserve took another big step toward raising interest rates. Despite 2021's many extraordinary headlines, the S&P 500 traded higher during the quarter and finished the year with a 28.6% total return. Small caps returned 14.5%, international returned 11.4%, and emerging markets lost 3.6%. Investment-grade bonds produced total returns of minus 1.9%, while high-yield bonds returned 3.7%. The Omicron variant emerged in the last week of November, and it was easy to see why health officials were concerned. The top chart shows the number of U.S. COVID cases is significantly above the Delta variant's summer peak, and the middle chart shows Omicron is becoming a bigger share of confirmed U.S. cases and rapidly replacing Delta as the dominant variant. While these two charts indicate Omicron is highly transmissible and spreading rapidly, hospitalization data, shown in the bottom chart, suggests Omicron may be less severe than prior variants. We're certainly not out of the woods, but this may signal a new stage of the pandemic whereby COVID flare-ups remain an unfortunate part of daily life, but their impact becomes more limited over time as businesses and consumers adapt to living with the virus. The U.S. consumer continues to be a bright spot. Demand remains particularly strong across goods categories such as furniture, appliances, and electronics. This is evident in the global shipping data, as this chart shows the quick rebound from the pandemic lows and sustained above average traffic during each of the last 17 months, contributing to supply chain and inflation issues. The catch-22 here is that consumer demand contributed to CPI rising 6.8% year over year, which was the fastest pace since 1982, and now poses a threat to that demand because it erodes consumers' purchasing power. The high inflation reports then caused the Fed to make an abrupt pivot during Q4, indicating they will need to raise interest rates more quickly and aggressively to combat inflation in 2022. This chart compares their projected interest rate path as the December 2021 meeting versus the September 21 meeting. As we look ahead, here's a quick note about markets during midterm election years. It's well known the markets dislike uncertainty, such as elections. So this next chart compares the S&P 500's price return path during midterm election years against all other years from 1950 through today. The S&P 500 historically trades higher during the average non-midterm year. However, during the average midterm year, it historically trades sideways for the first 9 months and then trades higher into year-end after election results are finalized. This does not necessarily mean history repeats exactly, but it does remind us to not get caught up in the moment as the two political parties battle for control of Washington. Since the depths of the COVID-19 pandemic in March 2020, the U.S. government has supported businesses and individuals with stimulus checks, unemployment benefits, pausing student loan repayments, and low interest rates. 2022 is likely to be the year the training wheels come off as the economy shifts from government support to private sector support. While this transition could lead to increased market volatility and lumpy economic data, it is important to keep the big picture in mind. Data indicates the U.S. economy is growing, the consumer is strong, and the recovery is progressing. In our view, it's hard to ask for much more. And as we close the books on 2021 and move forward with 2022, our team wishes you and your family a happy new year.